Welcome to Traders Lessons, your go-to trading academy for learning about chart patterns. In today's lesson, we will be discussing the falling and rising wedge chart patterns. The falling wedge pattern is a bullish reversal pattern characterized by converging trend lines sloping downwards. It is formed when the price consolidates between two downward sloping trend lines, with lower highs and lower lows. This pattern suggests that the selling pressure is weakening, and buyers may soon take control of the market. On the other hand, the rising wedge pattern is a bearish reversal pattern with upward sloping trend lines. It is formed when the price consolidates between two upward sloping lines, with higher highs and higher lows. This pattern indicates that the buying pressure is weakening, and sellers may soon gain control. Both wedge patterns are considered as continuation patterns, with the potential to signal a breakout in either direction. To confirm a breakout, traders often look for a significant increase in trading volume. In the case of a falling wedge, a breakout above the upper trend line may signal a potential bullish move. Conversely, a breakout below the lower trend line of a rising wedge may indicate a potential bearish move. Traders can enter a long position when the price breaks above the upper trend line of a falling wedge pattern. For a rising wedge pattern, traders may choose to enter a short position when the price breaks below the lower trend line. It is important to analyze other technical indicators and consider market conditions to confirm these patterns. Remember, patience and disciplined risk management are essential when trading wedge patterns. By understanding these chart patterns, you can better navigate the market and make informed trading decisions. Join us next time at Traders Lessons for more valuable trading insights and strategies. Happy trading!